Imagine a man with $0 in his pocket walking into a room of investors. He offers them 49% of a project he hasn't even built and walks out owning 300 million RMB in hotels. He never spends a single cent of his own money. For context, 300 million RMB, the official currency of China, is roughly 42 million US dollars. He utilized a specific financial operating system to move at this scale, a system 90% of entrepreneurs die never knowing. The ultimate barrier to scaling a massive enterprise is rarely a lack of personal funds. It is a lack of structural financial knowledge. To understand his process, we have to look at the methods most people use when they need capital. Option 1 is debt financing. You borrow from a bank, pledging your house and your car, or you ask friends and relatives for cash. If the business fails, you face court enforcement, asset seizure, and the destruction of every personal relationship you leveraged. The slightly more experienced entrepreneur tries equity financing. You give investors 80% of your company in exchange for their capital. If the business fails, you don't owe anything. However, if it succeeds, the investors control the board. They have the voting power to remove you from the very business you founded. Debt and equity both create a restrictive environment for the founder. You are either risking total financial ruin or trading away your ultimate control. Keeping your assets and your power requires a third path. The Fujian businessman started with an audacious pitch. He set up a new project company for a prime piece of land and demanded 51% majority equity from his investor. He contributed zero capital, citing his land acquisition, construction management, and hotel operations as the primary value drivers. He understood that investors prioritize 3 specific metrics over equity percentages: when they get their money back, how that repayment is guaranteed, and their exact profit margin. To satisfy those 3 metrics, he offered a structural compromise. This diagram illustrates the deal. On one side, 51% permanent equity. The other, 100% revenue and voting rights for 4 years. The timer counts down. The investor recovers their principal plus interest. The temporary rights vanish, leaving the structure permanently in the founder's favor. By satisfying the investor's short-term need for safety and speed, the founder acquired permanent majority ownership of a massive asset with zero personal financial risk. The hotel opened and operated successfully, generating 90 million RMB in annual revenue. Most founders would sit back and collect their share of those profits. Instead, the businessman utilized a tool called revenue right financing. This is a capital operations method where you treat future unearned revenue as a present-day financial instrument that can be bought and sold. This timeline shows the exact transaction. The businessman took 5 years of projected future earnings, 450 million RMB, and detached them from the upcoming years. He collapsed them into a single 400 million RMB block in the present day. He acquired cash by selling time. As that massive present-day capital block splits into 10 segments, he used it to fund 10 new identical hotels. Revenue right financing provides a founder with scalable capital without the typical friction of new debt or equity. It converts the promise of future success into tangible building blocks you can spend today. By applying that 400 million RMB lump sum to replicate his structure 10 times over, he scaled his operation into a 900 million RMB annual revenue empire. Other methods exist to build this same architecture. Consider investment promotion financing. This diagram shows a funding round divided into partnership slots. A central investor node buys in, and if they connect 3 new referral nodes, a refund arrow loops back to them, returning their entire initial investment. You turn your investors into a self-perpetuating sales force. Another method is revenue-based financing, or RBF. RBF is an agreement where you pay investors a fixed percentage of your monthly revenue, rather than a set loan payment. This removes the burden of fixed debt. If the business grows slowly, the payments shrink, allowing the repayment schedule to breathe alongside your growth. These methods, revenue right financing, investment promotion financing, and RBF, all share the same structural DNA. They require zero collateral, zero surrender of voting control, and carry no bankruptcy risk. The average person approaches business by risking everything they have on a single high-stakes bet. The wealthy take a different approach, engineering systems where other people's money builds their empire while protecting their own downside. The strategies we explored today are only a fraction of the true financial playbook. There are 30 distinct capital operation models available to founders who know where to look. Expanding an empire is a result of precise system design. By rearranging the financial architecture of a project, a founder can prioritize their own ownership while still satisfying investor demands. If you want to stop pledging your life's work to a bank, follow Engineering the Mind. You will learn how the architecture of money actually